If there's one thing decades of market history teaches, it's this. Great businesses and great investments are not always the same thing. A company can be extraordinary and still be a poor investment if the price you pay assumes perfection. And sometimes the market quietly offers you a second look at a business people once thought was too expensive to touch. Right now, that conversation is happening around Microsoft. When a stock of this size moves down, the noise begins immediately. Some investors shout, "Buy the dip." Others predict the start of a collapse. Both reactions miss the point. The intelligent investor starts with a different question entirely. What does the underlying business look like? And when you study Microsoft as a business, what you see is one of the most powerful economic machines ever constructed. Snorts. The company sits at the center of multiple recurring revenue ecosystems, enterprise software subscriptions through Office, global cloud infrastructure through Azure, developer tools, operating systems, cybersecurity, and increasingly artificial intelligence services integrated across its entire platform. That kind of structure matters because it produces something investors value above almost anything else: predictable cash flow. Microsoft generated roughly $77 billion in free cash flow last year. Not revenue, free cash flow. The cash left after operating the entire business. Few corporations in history have produced that level of financial strength. What makes the situation more interesting is that the company isn't just large. It's still growing at a rate that most businesses its size rarely achieve. Revenue recently increased around 17% year over year. Operating income climbed more than 20%. Earnings per share expanded nearly 24%. When a $1 trillion company grows earnings at that pace, you're looking at something unusual. But discipline requires separating admiration from valuation. A magnificent business can still be overpriced. For years, investors were willing to pay a premium multiple for Microsoft's earnings. Part of that came from enthusiasm around artificial intelligence. Part came from the low interest rate environment that made future growth more valuable in present terms. When rates are low and optimism is high, investors stretch their expectations. Eventually, those expectations compress. That's not failure, it's arithmetic. If you run Microsoft through a conservative valuation model, assuming revenue growth slows to roughly 7 to 11%, and margins remain stable, you might estimate an intrinsic value range somewhere between roughly $345 and $670 per share, with a midpoint around 485. If the stock trades around 400, it begins to look interesting, but interesting is not the same as obvious. A disciplined investor always asks whether the margin of safety is sufficient. Now consider the more optimistic case. If Microsoft maintains something closer to its historical growth rate, say 13 to 15% revenue expansion, aided by cloud demand and AI integration, the valuation range moves higher. Under those assumptions, intrinsic value estimates can push toward the mid-600s or beyond. That's the reality of investing. Uncertainty lives in the assumptions. Numbers change depending on what you believe about the future. But the bigger lesson here isn't just about Microsoft, it's about the structure of the entire market. The S&P 500 is commonly described as a diversified basket of the 500 largest American companies. Investors assume that buying the index spreads their risk broadly across the economy. In practice, the index has become far more concentrated. Today, the 10 largest companies represent roughly 38% of the entire S&P 500's market value. The top 5 alone account for about a quarter of the index. That means when someone buys a standard index fund, a significant portion of their investment is effectively a bet on a small group of mega app technology firms. This kind of concentration has appeared before in market history. During the late 1960s, the so-called Nifty 50 dominated portfolios. In the late 1990s, technology giants carried the market upward while many other companies lagged behind. In both periods, narrow leadership eventually gave way to long stretches of modest or disappointing returns. The risk isn't necessarily an immediate crash. Often the outcome is more subtle. Markets simply go sideways for a long time while earnings slowly grow into the prices investors previously paid. You can see hints of this dynamic by comparing the traditional S&P 500 to its equal weighted version. In the equal weight index, every company has the same influence regardless of size. The performance gap between the two versions has widened in recent years, suggesting that a small number of very large companies have been doing most of the heavy lifting. That doesn't mean those companies are weak. Many are exceptional, but when leadership becomes that narrow, the index itself becomes more sensitive to changes in valuation for just a handful of firms. And history offers a powerful example of what happens when expectations run too far ahead. Consider Cisco Systems during the technology bubble around the year 2000. Cisco went on to grow profits dramatically over the following decades, yet investors who bought at the peak waited many years before the stock returned to its previous highs. The business succeeded. The price simply started too high. Valuation measures across the broader market hint that investors may face similar dynamics. Again, the cyclically adjusted price-to-earnings ratio, often associated with Robert Shiller, has historically averaged around 17. At the peak of the dot-com bubble, it climbed into the mid-40s. Today, it remains far above its long-term norm. Another widely discussed measure, sometimes referred to as the Buffett indicator, because of comments from Warren Buffett, compares total stock market value to the size of the economy. Elevated readings on that metric historically correspond with lower forward returns over the following decade. These numbers don't predict timing. Markets can stay expensive longer than many investors expect, but they do influence long-term math. High starting valuations usually mean lower future returns. For younger investors still accumulating assets, this is not necessarily bad news. Periods of stagnation or correction allow them to buy productive businesses at better prices through consistent investing. For investors approaching retirement, the calculation becomes different. Sequence of returns risk the danger of experiencing poor market performance early in retirement can significantly affect long-term financial security. That's why understanding concentration and valuation matters so much, and the intelligent response is not panic, it is awareness. If you own a market cap weighted index fund, recognize that a large portion of your capital sits in a handful of very large companies. If those companies perform well, the index will likely perform well. If their valuations compress, the entire market may appear weaker even if many smaller companies continue growing. Cycles like this are normal. Leadership rotates, valuations expand and contract. The opportunity for patient investors is to focus on durable businesses and wait for moments when the market's enthusiasm fades just enough to offer a sensible entry price. Right now, Microsoft may be approaching that conversation, not necessarily screamingly cheap, but moving closer to the range where long-term investors begin paying serious attention. And that is often how wealth is built, not by chasing headlines, but by quietly recognizing when extraordinary businesses drift into reasonable prices. Markets will always create noise. Discipline is choosing to listen to the math instead.